We decided to not take management fees, asset management fees, acquisition fees, no fees, but we took a heavy promote. And that was the best thing we ever did. We were working for free, but because of the time in the market in 2010, 11, 12, when we were buying,
we don't necessarily have to make our own money. We can go get the money or find ways for the seller to give it to us. Like, we can get really creative.
There is magic that happens when you actually put pen to paper. And when you look at your 20-year goals to determine what your 10-year goals are, if you're born in poverty, it's not your fault. If you stay in poverty, it's your fault. It's funny, 99% of the people using chat only use 10% of the capability.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm really excited for today's guest. We have Jared Elmar. He's the founder of the Geneva Group. They're based in South Florida. They kind of invest in all kinds of different asset classes and have an awesome portfolio. I'm really excited to learn from you. So thanks so much for coming on the show.
I appreciate you having me.
Yeah, absolutely. So I've heard, nothing but I've seen you present at Commercial Academy events, and then I've heard nothing but good things from you. And our mutual friend, Taj, when he was here in Raleigh, he mentioned you quite a bit and was like, and I know he just recently went down there to work with you guys. So that's really cool.
Yeah, no, he's hitting the ground running. So we're happy to have him.
Yeah, he's a killer. For people who don't know, you give us a little bit of your background and some of your story.
I started in 1999. I was listening to a 2 a.m. infomercial, and it was a guy by the name of Carlton Sheets that was talking about his course, buying houses with zero money out of pocket. So I come from very humble beginnings. Nobody in my family's ever had home ownership. So to hear that you can possibly buy an asset with little to no money down, it was intriguing to me. And I put it on an installment sale. I bought the course. I worked that course for literally a couple of years before I actually got any real traction. I was doing odd jobs. I was working at Home Depot back in those days. And then one day I got a guy to take a chance on me. I put $1,500 down on a house that he owned where he was going through his third eviction. And he was just anxious to get rid of the problem. He was an older guy. And with $1,500 down, I bought the house, got my buddies to come in, renovate the house, and then we increased the rent with a quality tenant about $300 more a month. I had proof of concept. And then I bought another course to find out that all the most valuable homes are on the courthouse steps and tax sales. So I got really good at bidding at the auctions in the various counties. Around that time, Wachovia, which is now Wells Fargo, Wachovia was allowing you to tap equity out of these houses. So for the first time ever, I was able to tap like $20,000 out of one of the houses. And now I actually had cash to go to the courthouse steps and actually buy a house. And I just kept doing that. I kept tapping the equity on the deal on a house after we got it stabilized, and then went back to the county auction the next month. So I amassed 65 houses doing that. I got an unsolicited offer in 2007 to sell 55 of the houses. It was a crazy number. I couldn't say no to it. Godfather offer at the right time. Little did I know the global financial crisis was a year later. So it was really just dumb luck. And it really always helps when your first deal goes well. And it allowed me to stockpile my own cash to get ready for the REOs that started coming down the pike in early 2010. And then I got into apartments and then started divesting into retail and office. And it was kind of the evolution of a real estate guy, residential to commercial. It's very achievable. And the way I see it, you really can't scale. You certainly can't scale at the level that you in residential that you can in commercial. So no matter what a great streamlined process and system you have to buy single family homes. And we know a lot of guys that do that. And a couple of guys that have a lot of houses in the commercial academy, they cannot scale to the degree that somebody who buys millions of square feet of commercial real estate can scale. And it's easier to build a business around that.
No, absolutely. Absolutely. So you kind of were going through and doing almost like a Burr before it was really popular.
A what?
A Burr. Have you heard of that method?
Oh, the Burr Method? Yeah.
So it's kind of like you were kind of doing Burrs before it was a thing. So that's awesome. That's really cool.
Yeah.
So I'm curious, when you sold, your package of 55 houses, did you know at that point, I'm over this residential stuff and I want to get into commercial, or is somebody, mentor you and tell you to do that? Or did you just how did you come to that decision?
It's, if you get into a multifamily, you're buying the same faucets, you're buying the same toilets, you're buying the same sinks. When you're buying a cluster of single family homes, you're not buying the same faucet and the sinks, all the different fixtures and appliances. It's all different. So it was very hard to build a business around that. I know I didn't want to be a rogue investor always. I wanted to build a real estate business and build an infrastructure around how we buy, how we manage, lease and sell. And I couldn't do that on the residential side. That was really the decision I made, is where do I really want to get to? So, and I did one of those, it's such a cliche now when you talk about writing down your goals, but it happens when, there is magic that happens when you actually put pen to paper. And when you look at your 20-year goals, to determine what your 10-year goals are, to determine what your 5-year goals are, and then your 3 years and your 1 year and your 6 month, it's a lot easier to really build, what you want to achieve in your career and in your life. And that's what I did back then. And it told me what to do. I built the blueprint and I'm like, wow, okay, I got to follow it now. And it was getting into commercial real estate. So I was looking for another mentor, somebody else. And this was during the crash, right after the crash. I'm like, all right, I got to reinvent myself. I have some cash now. So I'm in a good position considering where we are now in 2009. And in 2006, I went to a wealth annex where it was George Foreman, Colin Powell, Donald Trump, and Tony Robbins was out there too. A guy by the name of Scott Shield opened up for Tony and started talking about buying commercial real estate with little to no money down. So I'm like, well, it worked the first time. Maybe it'll work on the commercial side. So I found out he was doing a boot camp in Atlanta, which was one of the first Commercial Property Academy events. And I was like, this is it. This is my next mentor. This is my next model.
That's so cool.
So when you were going back to the tax and everything and auctioning and stuff, so were you fully buying stuff with zero money out of pocket, and were you raising any money, or you and your buddies are just kind of figuring it out as you went?
When we got into the commercial side or resi?
When you were in the residential side trying to, build that portfolio, because it's where most people are, I think.
I had a couple private lenders. I was in the insurance business, and I did a radio show for 7 years in Boca Raton, Florida. And that was kind of my job. That's what I did for money. And then my money's job was buying real estate on the side. And that's really how I got into the residential side. And at some point, I wanted to be able to transition and stay focused on real estate as a whole. So I had a couple private lenders that weren't typecasting me as an insurance guy. And they came in on a couple of the houses. It worked out really well. They were just debt partners, no equity. We would structure it with, that one was an easy structure. It was just short-term loans. But then at some point, when I went to transition into the commercial side, now I really needed to build an investor base. And in 2010, I really started building that investor base. And it's all built, or it has been built organically. There's a million, there's guys out there doing crowdfunding. I don't love that kind of attention. I'd rather know every single one of my investors, and I do. And today, after all these years in our track record, we have 300 investors, 170 active. I started to realize that model works. You don't have to go institutional. You don't have to go private equity or family office. Retail, going with the retail investors, the country club money, family, friends, you can get to millions of square feet of real estate. One of my mentors, my main mentor these days, is my partner, a friend. We're in several deals together. He's been doing this for 35 years. And he's done it one deal at a time. And now the guy's probably worth a couple $100 million, but he still raises money for every single deal, even though he's got his own cash. At the end of the day, we only have a finite amount of our own money. And when there's real opportunities flooding the market, you can't be in every single one of them without an investor base. So that really is the goal now, is to just build square footage with my investor base.
Right. Yeah. Me and Graham actually had that conversation this week about, we don't necessarily have to make our own money. We can go get the money or find ways for the seller to give it to us. We can get really creative. I really appreciated you said that, you were using hard money, because me and Graham are trying to use that principle that you were talking about with residential stuff for the commercial side. So we're playing with a couple ideas, taking this, having the seller, put up 15, 20% and then carrying the rest with the bank, trying to figure out how that looks. And then the other side would be to get hard money, buy the whole thing. But the key there is to keep all the equity to ourselves. And that's what you did with residential. And I'm sure you've done the structures that you needed to make it happen in commercial. Usually we ask this question, and you don't have to share it if you don't want to, but usually we ask how you typically, you were saying, syndicate all these deals one deal at a time. What's your usual deal structure?
So it's kind of morphed over the years. Back in 2010, my first deal was a 156 unit apartment deal, and we bought it for less than $10,000 a door. So it was hard to lose on that deal, even though it was in a bad neighborhood. But that deal there was no banks to be had in 2010, especially for somebody like me who didn't have experience on the commercial side, let alone a 156 unit apartment deal. So I couldn't get bank financing on this deal. I structured at that time a debt and equity hybrid with the same investors. So I put up what I had. I think I had $150,000 to put up. I put up $150,000. They put up $150,000. We split it 50-50, and then they would loan the balance, which was another $1.3 million. They loaned into this property, this partnership. I think what it was, 6% interest, and then every 6 months, the rate would go up 1%. So I had a fire under my ass to really turn this thing around and sell it as fast as possible. So I was aligned with my investors. That's the structure that we're kind of dusting off these days because a lot of banks are still out of business, and where we are starting to look at that structure. The standard structure that we've been doing all these years is usually if it's a $5 million equity raise, right? Let's say it's a $12 million deal or $10 million deal and a $5 million equity raise. 50% of it is traditional debt with a bank. The other 50%, the other $2.5 million, we'll put up $250,000. So we put up 10% of the equity, and then we will raise the other 1.25 million. That 1.25 million. I'm sorry. $2.25 million. That $2.25 million will get a preferred return. Their dollars are in front of ours. That preferred return might be 6 to 8%. And then once we clear that hurdle, whatever it is, 6 or 8 or 9%, then in many cases, if it's a smaller deal under 30 million, it's a 50-50 split. That's how we do it. And there's a million different ways to skin the cat, but we kind of back into these numbers because I know what my investor base is expecting and as an annualized return. So I know I can sell a 14 or 15% annualized return to the investors because we have a great track record. It's a risk reward. If you've been with us for 12 years and 65 deals now, we've averaged 33.4% IRR, net of fees, net of promote, because we're so selective on the assets that we buy. Because of that, we're able to sell the idea of a 14 or 15 IRR because the risk is really mitigated because they know the operator. In the beginning, we could have never done that. So in the beginning, you're giving away the farm. You're just doing everything you can to bring the capital in, get proof of concept. But then as you become less risk to your investors, then you can start raising your promote. And that's really kind of how we did it. And in the beginning, I don't mean to go on with this, but it's important. In the beginning of my career on the commercial side, we decided to not take management fees, asset management fees, acquisition fees, no fees. But we took a heavy promote. And that was the best thing we ever did. We were working for free, but because of the time in the market in 2010, 11, 12, when we were buying on the basement floor. So that equity was so much more valuable than whatever fees we were going to collect. Since then, we flipped the script a little bit the last couple of years. Now we're taking traditional fees, and we're taking a lower promote structure. So again, it worked out well over the last 12 years, but since then it's kind of changed, and we're really focused on assets under management and not having to continue to sell and create liquidity events and ultimately have a tax burn every single time we sell an asset.
No, that makes sense. So for people listening who don't really know, we know we know these terms and stuff because we're around it all the time. But for people who are a little newer, can you explain maybe in a little more detail exactly what a promote is?
Sure. So if we're doing a 90-10 split on equity in that scenario, $2.5 million we're raising, we're putting up $250, they're coming in with $2.25 million. That's a 90-10 split. So they have a certain ownership percentage based on their 90% in, and then we have a certain ownership percentage based on our 10% in. That 10% that we're putting in probably only equates to 7.5% when you factor in the splits. So 7.5%. So our promote is anything above 7.5%. In the scenario I gave you before, it's a 50-50 split on ownership. So my 10% of money in gets me 50% of the deal. So that promote is 47.5% promote. That's kind of how it works. Hopefully I didn't confuse the listeners. Again,
No.
We're getting the bonus because of our sweat, our know-how, our expertise, what we're going to do, and all, to get it to the finish line. We're getting significantly higher ownership for significantly lower dollars. And whatever that spread is your promote.
That makes sense. Okay, awesome. Going back to that first one, I'm curious. You said you bought a 156 unit apartment complex for around $10,000 a door. Run us through that story of what happened, and I assume you ended up selling it and moving on.
Yeah, let me tell you that deal, it was the best and worst thing I ever got into. It was the best one because it really started my career on the commercial side. And my first syndication really was that apartment deal. But the worst thing was it was a Class C apartment complex in a bad neighborhood. So I really just thought all multifamily was built like that. It was just all the same, management intensity. Little did I know, if I would have upgraded and looked at the more Class Bs, I probably would have stayed the course on multifamily. Industrial has been great to us, but we should have kept multifamily in the mix. So I don't want to get off on a tangent. So what were you?
I was just wondering what happened. So you guys bought that deal. It was in rough, low rents and stuff. But what happened from there?
The best thing that I had at the time is I was too ignorant to know that I can fail and how bad I could fall on my ass on this deal, because it's not a deal I would buy today. I know better. But we got into that deal. We're bringing in the investors, closed on it. We're super excited. My first syndication, I got 9 guys to take a chance on me. Within 30 days, we had a murder. Drug deal gone bad. Within 60 days, we had 2 fires. We had a strong arm robbery. We had a truck that was a manual transmission sitting up on a hill in front of the leasing office. He didn't put it in park, or he didn't put the parking brake on. It rolled right down the hill into somebody's living room. So everything that could have possibly went wrong on this deal went wrong. And I learned very quickly that whatever you renovate on a Class C apartment complex, in 12 months from now, you're going to do all those renovations all over again because that property gets beat up so bad. So that's what I mean. This is an asset that I would never go back to. And anytime people say, hey, I got this 60s vintage apartment deal, and it's in this neighborhood and I'm getting it for $50,000 a door, don't be enamored with the price per door, because on paper, this stuff screams. On paper, it looks great. You can tell your investors, I'm going to do this, this, and this. It's never going to come to fruition. You're not going to be able to control your expenses on an older asset like that. The life expectancy of the systems within these 60s and 70s vintage apartment deals are dead. And over the last 5, 6, 7 years, the ownership groups that have been buying, it's been a hot potato. They're putting Band-Aids on these assets, flipping it to the next guy, selling the dream that, hey, rents are well under market. You can raise the rents if you change the tops to granite. It's all the same canned story. And now some of these guys that bought these 60s and 70s vintage over the last 3, 4 years are really hurting. They didn't realize their interest rate when they floated debt. They didn't realize their interest rate is going to go from 3.5% to 6.5%. They didn't realize rents were going to flatten out. They didn't expect expenses to blow out 30% because everything's just more expensive. Everything that could have, it was a perfect storm for there to be true distress in that class of apartments. So I probably answered too much, but.
No, you're good. So did you guys end up going on and selling that and doing okay on the deal, or?
We did great. And it was because we bought it in 2010, not because I'm so great. I did everything I could to turn that ship around. I lived in the model unit trying to figure out where the shootings were coming from, which buildings, to get rid of, to get security over to those areas. I did a lot of stupid things. I broke up domestic fights in the neighborhood. I mean, I could have been, killed a half a dozen times living there. And we wound up parachuting out of that deal, paid $9,700 a door. We used all the cash flow for debt service and renovations. And we wound up selling the property 16 months later for $18,500 a door. So awesome. It was a win for my investors. It was well executed in light of all the challenges we had, but it was because I bought it at the right time, not because I bought the right asset or I was so great at it.
Yeah. That makes sense. So I've heard a lot of talk, and I'm sure you have too. And I think last year when I was in Orlando, you were presenting on a multifamily deal you guys might buy. I've heard a lot of people saying the multifamily, there's so much trouble in the market, and there's going to be a lot of opportunity coming up this year, next year. Do you think that's the case? Do you think multifamily is something that's good for somebody to go look to get into right now in the current market?
I think it's time to start looking. I don't know if the steals are around. I know they're not. There's also a lot of liquidity sitting on the market specifically for multifamily. Where there's going to be real value, and again, not for us, like I would not be interested in this, but what I will say is for the beginner that's willing to roll up his sleeves and focus on that one asset, the older vintage apartment deals will start getting purged because these banks have a ton of bad loans. They're pretending like it doesn't exist. But at some point this year, they're going to start purging the weaker borrowers. the ones that can't turn the ship, the ones that don't have liquidity, where they're going to ultimately get foreclosed on anyways. So why delay? Because then you just have this glut of foreclosures in 3 years from now, and it hits the market like it did in 2009 and 10. So I do think that the banks are going to start purging those weaker borrowers probably in the second half of this year. And when that happens, there's going to be real value on older vintage multifamily. And listen, it's not all built the same either. If you're in there's Class C's in great neighborhoods. That's what we bought. We bought a Class C last year. It was 240 units in Atlanta. But we knew that there was so many new units coming online that we had direct competition with brand new construction on a one bedroom charging the same amount of rent we were, because all they were trying to do was fill it up and sell it as a merchant builder. So we knew that going in. And so we bought it at the right basis. It was very situational. The sellers had a loan coming due, floated debt, all the things I mentioned before. They took a $6.5 million bath on a property they just bought 2 years prior. And we knew it was going to take 12 months to let all these new units get absorbed so we can alleviate competition, and then we start raising rents. So we had the plan. And it's working out exactly how we thought. But it is a lift. It's 70s vintage, and it's had a Band-Aid put on it for the last two ownership groups. And it's more than we anticipated. And we're spending more time than we expected. But the way the numbers are trending are going the way we expected.
That's cool. That's so cool. So you started in multifamily, and, looking at your bio, and you talked about it a little before, you guys are buying industrial, office, retail, and then it looks like still multifamily. So was that first experience kind of what made you pivot into something else?
Yeah.
And talk to us about what you guys are up to right now with because your main focus is industrial, right?
Yeah, that's bread and butter. Yeah. Yeah. I mean, because of the stress, the aggravation of going through that, I'm like, there's got to be an easier product type. So the next deal we bought was a retail deal. And I was like, wow, what a breath of fresh air it was. It was a vacant CVS. We demised the box up. We got, different pet concepts in the building because we got one, and then we just wanted to draft off of that one. There was a veterinarian in the back in a shopping center in the back of the building. So I started to realize that synergy for retail is so vital to keep everybody in business, and they all draft off each other. That was really interesting to me. And we stayed on retail for a while, and we still have retail in the portfolio. But I was trying to really understand all product types to figure out where I could scale best and how I could build this empire that we all dream of. And I got into office, retail, industrial, and an industrial became the most simplistic. There's not a lot of finishes. It's not like multifamily where the turns are much more expensive. With industrial, a lot of times you slap paint on the floor and maybe put up one partition and you're good. There's not a lot of build out. You also have a lot of tradesmen. These boxes lend themselves to a lot of different industries and a lot of different trades. So that became the place that I felt we can scale. And it was the right move, especially COVID. That really helped us, and we couldn't have expected that. But industrial took off. Retail became the laggard, and industrial took off. So that's really been the heart of our portfolio. But we're still opportunistic. We're still looking at multifamily. We're still looking at retail. We're snipers when it's the right deal. We're not trying to buy 12 deals a year, but we are trying to take advantage of every opportunity we see.
So how do you recommend, because we touched on this with one of our last guests, Sean Katona. He was the last guy we did a podcast with. And, he's focused in Arizona and those markets, and he lives somewhere else. But I guess, how do you get to the point for somebody who's a beginner, or even like us, we're pretty focused on the Triad, which is just, it's like an hour and a half from Raleigh Durham area, but it's hard to know all these markets. And also, then you add on multiple different asset classes. So how do you recommend somebody getting to the point of where they can kind of recognize value and be a sniper when a deal comes up? And to kind of piggyback off that, are you guys focused only in one area, or is it, anywhere really?
Market wise?
Yeah, market wise.
We know 4 or 5 markets really well. I lived in Atlanta, Georgia for 4 years, so I know the market. Plus, I had all my houses pretty much in Atlanta, and they were scattered all over Atlanta. So I knew the good pockets from the bad pockets because I was so spread out. So that helped. And living in South Florida, when I moved back to South Florida, I delivered a Florida investor base, something they didn't have before, which is a different market. So Atlanta's always a market that we're looking at because we know it so well. and really all over Florida. Most of our portfolio is concentrated in Central Florida, Jacksonville, Tampa, Orlando. We have Palm Beach, we have Broward County, Fort Lauderdale, and then we have Atlanta, and we're flying up on Monday on a deal in Nashville, and we're looking at stuff in Charlotte. So it's the Southeast, and it's markets that I want to be in. It's markets that I like, that I don't mind visiting, and it's markets that are easy to get to. So I live on the East Coast. I live in Boca Raton, which is Palm Beach County. I won't buy a deal in Tallahassee because even though it's the same state, it's 2 flights. Unless you're chartering, you're spending a whole day of just really traveling. We do take that into account. And, Huntsville, Alabama, great market, but it's hard to get to from where we are.
Yeah.
So we stay focused on Atlanta, Charlotte, Nashville, and everywhere in Florida. So that's worked for us. But look, we know guys, you guys know the same guys that buy all over the country. But the market, if you really understand the market, then you understand what's a good deal better than if you just, if you're the dummy that buys in the middle of the country as an out-of-state buyer, none of the local people want it, but you want it. Well, that's probably because you don't know the market so well.
Yeah.
So we really stay focused on the markets that we know best, and we try not to deviate and not have shiny object syndrome when deals are brought to us that look so good on paper, but we just don't know the market.
Yeah. So I guess
I would encourage everybody to focus on a market, get to understand it in and out. I mean, that's the great thing with you guys on the City Plat guys. They know, you guys know Raleigh like the back of your hand. So it makes investing much less risky.
Yeah, that's definitely true. So your recommendation for somebody brand new would be probably just look at one market to start and get really good at that one market, right?
Yeah, learn every nuance about the market, get to know the building owners, how long they've owned it. That's how we got started. We got started in one specific market, and then we started branching off.
Yeah, we're in, like I mentioned to you before we started recording, we bought 2 buildings last year in High Point. They're both single tenant industrial buildings. One of them's 6,000 feet, one of them's 18,000 feet. High Point's right outside of Greensboro. It's probably like an hour and a half from Charlotte.
Furniture manufacturer capital, right?
Exactly. Yep. Yeah. So it's kind of a smaller market, but we've just kind of come to know it very, very well. So I'm curious what your opinion is. We're kind of thinking about buying several more of these single tenant, 10,000 to 20,000 square foot buildings and building a portfolio of like 5 to 10 of them, just to kind of start and focusing on that over the next year or so, or 2 years. What's your opinion on that? You think it's a bad idea? Because single tenant is a little scary. I know they're smaller buildings, but I'm curious to know what kind of your opinion is, because I know you like multi-tenant stuff a lot.
I think your risk is the cash flow, because you lose the tenant. Now you have no cash flow for that property. But I think the opportunity to buy these, maybe rent them out, maybe just fix them up, maybe throw them back on the market and sell to an end user. I believe that what you're looking at is actually a pretty good way to start, because you're going to find, I don't necessarily know if you're going to be able to build the portfolio like you want to, but to buy, fix up, and sell it to an end user is a huge opportunity right now. 10,000 feet, 15,000 feet. And they're going to pay significantly more than any investor's going to pay. You're going to buy it based on an investor's value of it. They're going to buy it based on their business, value of it. So there's a huge arbitrage there.
Yeah, we almost had that. We almost had that happen. We bought, we put it under contract, bought it for the little one for $250. So it was a really good deal, $40 a foot for a 6,000 square foot building. And we were marketing it for lease, and somebody came along and said, "Hey, would you sell this?" We were like, "Yeah, we'd sell it." So we told them, like $425, because that actually was closer to what the market price was. And we put it under contract for 60. No,
it was $67 a foot, I thought.
But then we put it under contract for $375 with them.
Yeah.
And so we almost went from $250 to $375 in like a span of 2 months, and we would have been very happy with that. But they ended up backing out, and now we leased it. So, but that's a great point. So that kind of goes to the discussion. And sorry, Jesse, I didn't mean to cut you off. I'll let you ask right after this, but just while my brain's going, that's the question of like buy versus hold. And that's something I wrestle with. It's like, if we find these good deals and, we can get good cash flow out the gate, it just takes a little time to rent them, and we're going after the cash flow. How do you determine whether or not you should sell it? Because obviously, making a couple $100,000 would be life-changing for me and Jesse right now. So that's also, how do you balance that?
In the beginning, you have to sell. You have no choice. You're raising money, I think, right? You guys are raising money from investors?
Somewhat. One of them we just raised from one guy because it was $250,000, so it was only $60,000. The other one I 1031 to residential house and got a 10% down seller financing deal.
But as you buy and start building your portfolio, you're probably going to need investor help. You're going to need
Mhm.
investor equity. Investors are expecting it to get their money back at some point. But
Yeah.
more than that, you have to build your resume. This is the time to do it. Buy, you fix up, you go with a business plan that you sold to your investors, and you exit so they can see that you actually crossed the finish line. And as you do that over and over and over again, there'll be a point in time in your career where you don't have to sell anymore. You've stockpiled enough of your own cash. You have proof of concept with your investors, so you don't have to prove to them anymore that you know what you're doing. Then at that point, you start to look at not selling and holding on to the assets, because that is where generational wealth is made. A transactional investor will make a very good living. You know, we're in one of the best industries I can think of, especially if you didn't go to college like me. But you, I lost my train of thought. You
Got to sell? Is that what you're going to say? You just got to sell?
right now, you're going to get to a point where you just don't have to, you don't have to sell. And you're going to find out ways to get liquidity events for your investors by holding the portfolio. There's a million ways to skin that cat too. But that's where, you know, you make a good living. That's where I was going with this. You make a good living being transactional and flipping and doing everything you said you're going to do. You get uber wealthy, generational wealth when you don't sell real estate. And, you know, I'm lucky enough to be in South Florida where you have a lot of wealthy, older people that are, you know, living the life at 85 years old and playing golf every single day. So I talk to these guys all the time. And the guys that are and I'm talking 9 and 10 figure guys, they're the ones that have been holding their asset for 40 years. They're the ones who developed it 40 years ago and never sold it. That's generational wealth. So that's the stage you'll get to, but it's an evolution. It's you got to put in your dues. You got to build your resume, and you know you got to deliver returns to your investors, and you got to stockpile your own cash. So you have no choice. You have to sell. The business of syndication is to sell, and then at some point you have patient money. You have patient investors that love the annuity. And that's where we are. We always underwrite a deal in the beginning as if we're going to sell it in 5 years or 7 years. That's how we arrive at our returns to our investors. We have to have an end date. But that end date isn't set in stone. It's not a hard and fast rule. So as long as we're delivering these distributions, you know, somebody making 9-10% on their original investment in the deal, you know, a lot of times they don't want their money back. Where else are they going to get 9 to 10% steady Eddie? So that's what's been happening. People want the annuity. They want the multiple streams of income. And that's where you want to get to in your business.
Gotcha. Yeah, I think you make a good point too, and being transactional helps you survive too. That's kind of the big thing starting out, is what I've been told as well. I think where we're kind of coming from is the balance of, is the cash flow in these deals what's going to help us survive, or is it going to potentially drown us when we don't have it, like you said? Because we can potentially chop up these buildings, but you know that takes money too. You can't just throw up a wall, and that takes money as well. So we'll go ahead.
There's a great, there's my screensaver says, "What don't I see?" That's my screensaver. And Keith Cunningham, who wrote many books, he talks about, what's the upside? What's the downside? Can I live with the downside? When you're starting out in your career, sustainability is the name of the game. Can you sustain the building for a certain amount of time if all of a sudden you have no cash flow? If you're paying debt service, expenses, can you sustain for the amount of time that it's going to take to backfill that space? If the answer is no, then you got to make sure you have that planned sale in mind as soon as you buy it. And we're looking at a deal, and it goes like that from the junior investor to the seasoned investor. We're looking at a deal in Atlanta right now. It's 130,000 feet. We have a 30,000 foot tenant that we're not sure if they're going to renew. We're running all these sensitivity analysis to see where we can sustain and how long it's going to take us to fill that 33,000 feet. Because if they go, we're out of compliance with our bank, which creates a whole new set of issues. Distributions are shut off. And now we're going to have to prepare to put a bunch of tenant improvement dollars and reconfigure the space for the next user. So we're thinking about all that, $25 million deal. It's the same thing on a $250,000 deal. Can you sustain if the worst case scenario happens?
That's a great point.
Yeah.
That's a great point. So walk us through a little bit, kind of pivoting back to your portfolio. What does your guys' portfolio look like now?
So we're at we're just under 1.6 million square feet. I would say 60% of that is industrial. I pride ourselves on the fact that we are currently about 50% leveraged loan to cost. So we're probably at about 350 million of net asset value, and our debt is less than 110 million. So that makes us sustainable. Now, my goal is to get down to a third leveraged, because now you can weather almost any storm at a third leverage. But in the beginning, It's people forget, or investors don't realize that there's many monetary legs in commercial real estate. Obviously, you have the upside potential, upside appreciation. You have the cash flow. You have the tax benefits. But the one thing that people miss is the fact that you got a bunch of tenants, 1 tenant, 5 tenants, 20 tenants that are paying down that mortgage for you each and every month. And that hits your bottom line each and every year. I mean, every month. If you're writing it all down, it's more equity buildup. That when you have a bunch of assets that you haven't sold and you're hammering down debt every single year, your tenants, you don't even see it. You don't feel it. That's magic. That's magic. And right now, so we're paying down $1.7 million, $1.8 million a year in debt service. Principal pay down. That equates to me, that's about $600,000 a year based on our promote structure and what I own of the asset. $600,000 a year that hits the bottom line that doesn't impact I'm not feeling it. I have my distributions, but that mortgage pay down is your bonus. That is magic.
Yeah, that's crazy. So like your net worth is going up by $600K every year if you just stopped right now.
Everything flatlines.
That's awesome. That's so cool.
And that is the magic. And then people miss that and they buy and they flip and they sell and they're so happy to make, a 30% return, 50% return, or even a double. But when you look, if you run a model over a 10-year period and you see how much debt you can pay down, and if the property doesn't even increase in value, how much more equity you have, it's staggering. It really is. It's really a fun exercise when I realize that.
Kind of going back to our portfolio, I'm going to ask this selfishly, but I think a lot of people are going to get some value out of this. So, we've done a little bit of proof of concept. Really, we're finding these vacant buildings and we're kind of creating 12 plus caps like City Plat always looks for. What's going to take us, you think, to the next level? Is it going to be selling off these buildings to owner users, or is it going to be finding like the portfolio? We've just been kind of asking ourselves this question of what's going to get us to the next level, because we're still kind of in this brokerage wheelhouse, if you will, of like, oh, we've got money, no we don't. Like we want something consistent, and these buildings could be the answer, but like you mentioned before, it could be what drowns us. So kind of curious your thoughts of what's going to take us to the next level.
You're spending all your time looking at your deals for your own portfolio, or are you still doing brokerage?
Some brokerage, yes. So we've done some retail stuff. I'm pretty new in brokerage, but I've done like 2 or 3 deals. Nikita bought one of like an industrial building, and then I sold a couple of retail centers. But
we're definitely still to the point of like brokerage is our day job and has to be.
Exactly.
And then we are obviously looking for City Plat to find bigger deals and stuff, and then the smaller type deals we're trying to go after personally.
100%.
Yeah, and at the stage that you guys are in, anybody at this level, they should be selling. They should be selling. It's going to change for you guys. This is, you are building, you're building your reputation right now, and you need to be able to take advantage of opportunities and pounce on them. And the opportunities are coming. We're in a really good environment for some value add in the next 6 months to a year. So I would advocate for you guys to focus on end users, focus on markets that, High Point is very specific. I know that market a little bit. Try to stay out of the tertiary markets. Try to go for tier 2 markets. Raleigh's now, it's tier 2, but for North Carolina, that's a tier 1 market. Charlotte's a tier 1 market. You don't necessarily need to do that, but right outside. Those are the markets that you really want to focus on. Buy the smaller deals and sell it to an end user, because right now SBA money is the easiest to come by. If you're an established business, and every one of these established trades, any tradesman, they're getting killed with rent increases, because everywhere in industrial is just going up in all the major markets. So they're constantly getting hit with higher and higher rent. They're like, screw this, I'm going to go buy my own building. And there's not a lot out there. So if you guys can snap them up, fix them up, and sell it specifically to end users, you're going to stockpile cash very quickly.
That's a great strategy. It's kind of what that was one of the things we had definitely considered. Like I kept saying to Jess, is like, man, then we just need like a flip or like a decent pop where we can get one of these and not hold on to it because we like it and get attached, but just sell it and to get a decent pop and use that money for, like you said, just to kind of look for other opportunities, and then we actually have some. So that's a great point. Yeah, that's a great point.
There will be a time where you won't sell, but you're not there yet. It's important to make sure you have a stockpile of cash for those opportunities, because that was what set me free. That the fact that I sold those houses and I had the cash to put down in that apartment deal, and I put my money where my mouth was, and I was able to attract investors. It was just all encompassing. It was, all the stars aligned because I had the cash ready to go.
That's awesome.
Yeah.
I'm curious, being in South Florida, do you ever, I follow a guy, I'm sure you're familiar with him, but Ben Mala, he's all over South Florida. And then obviously, Grant Cardone's a big name and stuff. Do you ever run into any of these like big players or competition, I guess? Maybe they're not competition, but.
Not on a deal side, but like Grant's about 15 miles down the road. So, he's out there, and, his persona, his social media persona is very different than how he is personally.
Oh, cool.
The guy's a marketing genius. But, obviously he's got that douche factor.
Yeah.
But that's how he gets all these eyeballs. But he's actually a good guy and an extremely intelligent guy.
Yeah, definitely.
So yeah, we see them, but we don't bump into each other on deal flow. We're not buying $100 million multifamily deals in Tampa, or markets that he's doing. He's buying industrial. We bump into. See, you guys are in a big market too. There is enough for everybody. My direct competition, which a lot of times that competition becomes my JV partner. 90% of the deals we don't bump into each other. It's amazing. That's these major markets. There's so much inventory that a lot of times you don't bump into them. You're lucky enough to be in a really good market.
That makes sense. So I've noticed on something we talk about a little bit too is like, obviously we're doing the podcast for trying to build like a brand and reputation, like you said, to have kind of a track record, talk about some of the deals we're doing, the wins we're doing and stuff. I see that you've been doing, it seems like more social media type stuff. Are you guys trying to kind of build a presence online and use that to get more investors? Or I'm curious, like if you have a strategy there.
Well, right these days it's a little bit more self-promotion. I have my book coming out. It's coming out in April. April 8th is the drop. Audible will be in May.
Okay.
And really getting the word out on my story. And, the book is really about my upbringing and all the reasons I had to not be where I am today. No father in the house. Mom had issues and lived in an efficiency apartment with my grandfather on $1,500 a month. So I had very meager beginnings. And then most of the book is really real estate war stories, how I structured my first few deals, how I've kept in touch with my investors and engaged with them all these years where I barely talk to most of them. But because I do my video updates on a regular basis, they feel like they're talking to me all the time. I'm answering questions before they're ever asked. So this has been distilled over a lot of years of building an investor base and buying real estate where we really have to do a great system. So the social media does allow to stay relevant to my investors, to let the brokerage community know that we're actively buying. And also to, get the word out that this book is coming out. And, if I inspire a few people, fantastic. That's what I'd love to do. And if somebody can take something, valuable from the book to help them with their own portfolio, I've done my job. And that is my goal, is to try and bring as many people as I can up this hill with me.
Yeah, no, that's awesome. I'm 100% going to check that out. I'm excited. Is there anything like, if you just want to give us like an elevator pitch for, I know you mentioned it's kind of the general structure, but anything people should know specifically about the book and why they should pick it up?
Listen, I talk a lot about negotiation. There's a lot of negotiation books out there, but I have real world stories in this book. In the book, it's really negotiations from a street kid. I dropped out of high school. I never went to college. I came from bad neighborhoods. I was in 4 high schools in 4 years, and I didn't end up graduating at all. So I was my IQ people can beat. My EQ people can't. I'm at the top, and I know it. I'm just very aware of everything going on around me. I can see around corners that my Ivy League team can't. They could do things so much better than me in so many ways. But when it comes to looking at the intangibles and understanding when there's a time to move and steal, Scott always talks about you can't steal in slow motion. I know when that moment occurs better than anybody in the office. So I talk a lot about that and how I'm able to kind of sense when there's an opportunity like that. Things that you don't even think about, possible lease, buying out leases to maximize value on the properties. Obviously, all the creative financing, master leasing and owner financing, and all the different ways that I had to buy real estate as a necessity. Now, we still go after owner financing on every deal we do. There's a neon sign in my office that says "Started from the bottom," and it's a Drake line from a song. And one of the other things he says in one of his songs is always wake up like the rents do. And that is what we do every single day. Just because we have a couple dollars backing us now, we still we still go with the grassroots structures that got us to where we are. And owner financing, I'll buy $100 million deal and I'll still I got the guy to hold paper.
Yeah, no, that's
There's no
owner
why not?
financing is like it's a game changer. I mean, that's how we got this deal. Yeah, it's
Why
like the
not?
best possible thing you can do. That's awesome.
And so all that's in the book, and it's pretty. It's funny. You're always your worst critic. I threw the book into Speechify. You know Speechify?
I've heard of it. Yeah.
Speechify. Basically, you take any PDF, any article, whatever, you dump it into this app, and it just talks to you, and it gives you different voices to use. So I threw my book in. And I'm going to be narrating my book, but I had Snoop Dogg narrate the book on Speechify. And I'm like, I don't know if it's his voice or if the book's this good, but I'm really happy with how it
That's awesome. I'm 100% going to be buying it as soon as it comes out.
Yeah,
so I'm excited. I'm really excited. Yeah. But reading, I actually was talking about that recently. I was talking with my friends who's a younger than me, very successful. And I was like, dude, you should read this book because it would really help you with the kind of an issue he's going through. And he's like, I don't read. I was like, what are you talking about? You don't read. And that's something that like at CityPlat, I was kind of that way before where, I'd read every once in a while, but I wasn't a big reader. But then I joined CityPlat 2 years ago, and every single weekly meeting, we talk about the books we read, the things we learned from it. And like reading is it's just an unlock for growth, and especially in real estate too. I mean, you could take somebody's entire journey and read it in, a couple hours, 3 hours, whatever, and just get so much from it.
If somebody like me can go through these bad, everything that could have happened negative in my childhood happened: school, family, no structure. And if it wasn't for the books on tape, books on CDs, Audible, podcasts like this, YouTube videos, there is so much free content out there to give you the basics, the fundamentals, to even see if you want to be in this business or any business for that matter. All the content is out there. So for anybody that doesn't read, I mean, or take time to self-develop and self-educate, shame on you. Bill Gates talks about this. He says, if you're born in poverty, it's not your fault. If you stay in poverty, it's your fault. And in the U.S., it couldn't ring more true. There's so much opportunity. And regardless if people think that this is a bad time to be in the world or a great time, I think this is one of the best times ever to be. I think this is the greatest moment to be in the world. Yes, there's conflict and there's fighting and there's hatred and things that I'd love to be part of to cure the issues, but how fast information is forming now, and AI has been such a game changer. I mean, the internet changed everything. AI is going to change everything. Yeah. There'll be negatives, but there's going to be a lot of positives. And it's just going to make everything much more efficient.
Yeah. Well, somebody out there is always going to say what's wrong with something. It's what you just got to make the best of whatever situation you're in. And then with AI, you just got to use it to your advantage. So I'm kind of curious if you guys are doing anything specific with AI. I love AI. I use ChatGPT all the time. We've built our own, underwriting things, but just curious what you guys are doing.
Yeah. There's a couple things we're doing that I'll tell you at a later date. But as far as lease abstracts and some of our due diligence, what we run in due diligence, we're using different AI overlays, investor reports, investor letters, obviously. It's all making everything just a little bit more streamlined, more efficient, and more very clear to our investor base specifically. So I'm embracing it. I'm trying to learn more and more about it. Again, chat's everybody's best friend, or it should be. It's funny, 99% of the people using chat only use 10% of the capability. There's so much that you can use it with chat. It's staggering. It's amazing.
Yeah. One of my latest things is I've done like a project, and yes, it's just to come it's a folder basically of like all their threads and stuff, but I make sure that I'm putting everything into it so it knows common questions that I have, and it keeps knowledge a lot better. So I don't know, it's just a little bit of tip. It's not a lot, but I mean, honestly, it's better than creating your own ChatGPT, in my opinion, just because it keeps the knowledge base a lot better.
Yeah, that's amazing. That's great. Yeah. It's going to continue to upgrade. It's continue to refine.
Yeah.
I got a question for you. We're getting close to the end of an hour, but I got two questions for you. One, what's behind the name of your company? I'm curious.
I love when people ask that question. My favorite movie of all time is Wall Street, the first one with Michael Douglas and Charlie Sheen. That movie has coined so many different phrases that are used on Wall Street every single day now. And there was a scene in the movie where Michael Douglas is talking to Charlie Sheen with his lawyer out in his backyard, and they're talking about how they need to use the offshore accounts in a company named Geneva Roth Holding Corp to make the trades. And I just remember being, I don't know, 13 years old, 12 years old. And I'm like, God, that's such a cool name, Geneva. Like I definitely, when I start a company, it's going to be Geneva. And that's what it is. It's Geneva Roth is the actual name, but the DBA is the Geneva Group. So that's kind of
awesome.
I'm a movie buff, especially 80s movies.
That's awesome. That's really cool. That's not what I would have guessed.
No.
Well, and Geneva, it's like Switzerland. It's global wealth, privacy. People think of that with Switzerland. So
yeah, that's cool.
They used to have a disdain for big government, but it's changed a little bit.
Yeah. And then the second question I would ask, obviously follow you on Instagram and stuff, and I've been seeing the progress of your house. It looks awesome. Talk to us a little bit about that.
That has been the labor of love. I love being on the water. I'm in South Florida. I mean, in my opinion, I live in paradise. Every time I go to the greatest places in the world, if I travel, I'm just so happy to come back home because it's just amazing. And to be on the water, if I'm not on my boat, I'm watching boats go by. I'm going to live longer living in that house. So it's there's a book out there called Die with Zero. Yeah. And the premise of it is not to necessarily die with no money, but to look at the window of your life that you can do the most with physically, and mentally, go on the hiking trips now, because at 65, you're not going to be able to go on the hiking trips. Spend the money now, be the consumer in a certain window of your life. And right now I'm in that window, and, whether it's the right time to build this house or not, life is too short, and I've had too many people around me not live as long as they expected to. So this has been like the reward for grinding as long as I have.
That's awesome. I love that. I love that perspective too. What kind of boat would you have?
I have an 80-foot Azimat. I have a couple of partners, but we're not roughing it on the water. It's nice.
That's cool.
I don't want to captain a boat. I want to entertain. I want to drink. So we have a captain for that.
Yeah, that's so cool. I mean, that kind of stuff is like, I think it's important for people to hear, because for people like me, and I'm sure Jesse too, it's inspiring. Like I'm the same way. I love being on the water, and it'd be sweet to own a boat one day, and something to work towards. So that's awesome.
Like it. There really is nothing like it. I mean, I love the mountains. As I get older, I'm starting to really appreciate, Colorado and Utah, but the water is a non-negotiable.
Yeah. Well, for people who want to connect with you and, reach out and talk with you, where's the best way to do it?
I could look. Our website is Geneva GP, like Geneva Group, but just GP.com. Our Instagram is my Geneva_GP, and you'll get all the information. You'll see assets that we own, any updates, offerings that are coming out. Yeah, again, I'm pretty easy to find. Apparently, I'm the only Jared Elmar on the entire planet. So if you Google me, I'm the only one that comes up. So
that's cool. That's a good thing.
That's good.
It's a good thing as long as you got good press.
Yeah. Awesome. Yeah. Awesome. Well, thank you so much for coming on. I've learned a ton. I hope everybody else was able to learn a ton, and we really appreciate your time.
Absolutely. Appreciate you having me, man.
Yeah. Thanks.